Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading stocks, bonds, and crypto assets from around the world. The financial crisis in China is now worse than what we saw in 2008, which is insane because that was a real estate catastrophe. A global financial crisis, so what the heck is going on for real on the ground in China? And what is all of this pain going to mean for America?
When we invest in clean energy and electric vehicles and reduce population, more of our children can breathe clean air and drink clean water.
What all this pain means for U.S. stocks? Stocks Jeremy has been buying very heavily, like Nike and Estee Lauder. What's the crazy Gullible plan PBOC about to do? Why I believe they will actually make it worse. Is Jeremy's new stock pick Estee Lauder investable right now? Jeremy Financial Education's fresh stock pick Estee Lauder has just lost investors a lot of money.
5 stocks I'm buying now, August 2024 edition. Next one up here, number 4 of these 5 stocks is Estee Lauder. There's a $97 stock here today. I have a $300 price target on the stock long term. It's a beaten down dog. I just bought this stock today for the first time ever.
Lost investors more than 13% so far, after he told everyone he is buying it in August.
Number 9 of 26 stocks. I do own this one. It is a recent buy for me. I spoke about Estee Lauder, if I recall, extensively on 4 stocks I'm buying now, September 2024 edition.
It's funny that he didn't even remember when he bought his own stock. You know the reason why Warren Buffett is such a great investor is that he remembers all of the things he read. All of the numbers, ratios from the 10K he read.
Warren's opinions of Wall Street investment bankers would not endear him to their mothers. He feels that they're, for the most part, not out for their clients. They're out for their own business interests.
Jeremy can't even remember which month he spoke about an investment he has made. Anyways, this video is not about Jeremy. It's about the Chinese financial crisis and all the businesses that are affected by the Chinese weak consumers. What are Estee Lauder's China's problems? Why it is not a good idea to buy EL stock right now. It is a value trap. He is catching a falling knife again. Everybody thought it was cheap at 200, cheap at 150. Now I am saying that you could still have another leg down. Looking at the L'Oreal results, China looking weak for the consumer, and it will weigh on them for a long time. I mean a long time. I think it is cheap for a reason. I can't touch it right now, but maybe later on. I might be interested if it gets really cheap. At least it has to be cheaper than my Lululemon stock for me to consider buying. Estee Lauder said CEO Fabrizio Freda will be retiring at the end of fiscal 2025, which is great news for the company, in my opinion, because this man is a greedy CEO. He is one of the most overpaid CEOs ever. Organic sales in the Americas down 5%. With declines in department stores which offset growth in other distribution channels. A strong competitive environment and the overall slowdown in growth in prestige beauty in North America. Organic sales in the Asia Pacific region dropped 4%, primarily driven by the decline in mainland China. CEO sees continued declines in the prestige beauty segment in China. Estee Lauder also noted full-year revenue fell 2% because of the tumble in China and Asia travel retail. Freda said they anticipate continued declines in the prestige beauty segment in China, mainly reflecting persistent weak sentiment among Chinese consumers. Chinese consumers are saying no. Not just to the US brands, but also to European companies. The high growth phase of the Chinese economy is over, says Barclays analyst, as they downgraded Adidas, Burberry, and Gucci following a 2.5-week trip to China, in which they grew more cautious on the world's #2 economy. Analysts Wendy Liu and Carol Maggio said they went to visit the brands, luxury malls, retailers, investors, and other sector experts. The sentiment on the ground was much more cautious than 6 months ago, as there is now a clear view that the Chinese weakness is structural. They conclude the high growth phase of the Chinese economy is over. The finance and property sector are now under pressure and are no longer viewed as cash cows. The private sector seems to be shrinking, while state-owned companies are getting larger. In China, the view was that the luxury market may take 3 to 4 years to improve. This led the analysts to downgrade their 2025 growth expectations for the luxury sector to 4% from 7%. They cut Burberry to underweight from equal weight. To us, our trip to China clearly highlighted that Burberry is putting its luxury brand positioning at risk through promotions and high outlet exposure, which could have long-lasting impact on its brand equity. They say, also noting it's likely to turn loss-making into the first half of 2025. Gucci continues to suffer a heavy sales decline in China, worse than peers, as it also downgraded Kering to underweight. It prefers high-quality names including Hermes, which isn't fully immune to the Chinese slowdown. The Barclays view on sporting goods was similar. Most brands have reported weak brick-and-mortar traffic since Q2. And their channel checks in China indicate the trend deteriorated further into the summer. Not helped by the hot weather across many cities this year. Burberry is not alone on its waning fortunes. The luxury sector as a whole has suffered from a prolonged downturn in consumer spending amid inflationary pressures and broader economic uncertainty. Chinese luxury consumption has been especially hard hit. In July, Europe's luxury brands Hugo Boss cut its full-year guidance after reporting a fall in sales, notably in the UK and China, while Gucci owner Kering issued a weak forecast as a marked deceleration in China weighed on the first half revenue. LVMH revenue also fell in the second quarter on weaker sales in the Greater China area. So what exactly happened? Why has this growth just disappeared? From 2019 to 2022, rounds of free money courtesy of central banks and governments fueled gullibility and blind risk taking in many countries. The effects were particularly short-lived in China, the world's second largest economy, where consumer confidence has been dead over the past 3 years. Hampered by relatively low household incomes and a limited social safety net, Chinese households must save large portions of their income to self-fund things like sick care and retirement. In 2005 to 2007, as Chinese exports expanded, hopeful households poured what they could into equities, creating a self-fulfilling bubble that drove asset valuations to irrational highs. Chinese stock prices then tumbled about 70% into 2008. Chinese stocks have slumped since and are today about the same level as 2006. Between 2005 and 2021, the masses doubled down on the housing market, borrowing as much as they could in hopes that rising prices would win them financial stability. For many, it did the opposite as debt and overhead costs ballooned. Pressures are now intensifying as home prices fall in many areas. Chinese home prices for new and existing properties have tumbled to 2015 levels in the 70 largest cities. At the same time, Chinese real estate company shares have slumped more than 80% since 2020 and are now trading at the lows of the 2008 financial crisis. As the economic outlook deteriorates, Chinese government bonds have continued to rise on safety-seeking inflows. And the 10-year government treasury yield has fallen to 2.11%, the lowest level ever since 2005. China bond yields now sink to record lows with intervention in focus. We know this is happening because where the banks are positioned, to begin with, they lent a bunch of money to the property sector. And we know there's a bunch of unfinished or empty homes in China. There's no demand for them. And as the home price starts coming down, here comes the problem. We're seeing the economy slow down there. We're seeing consumers say, look, I don't want to buy a house in this market. I have no confidence I can pay the mortgage. And that's a problem because what is going to do is lead to a collapse in the housing. That's going to lead to a collapse in the bank, which makes the move the PBOC is going to do even more outlandish, as they're going to intervene more aggressively to sell bonds and lift bond yields from time to time. But why would they do that? With mortgage growth stalled, China's government is trying new schemes to reduce mortgage carrying costs without wiping out bank lending profits. It is all because of PBOC. However, it makes absolutely no sense. Higher rates can reduce the bearish sentiment. It can only do the opposite. This is something central bankers don't get either. That interest rates are a function of growth and inflation expectations. They're trying to drive yields up in an economy that's slowing down. The yields want to come down and they keep pushing against it. The longer they keep yields up, the slower the economy gets. Next thing you know, there's nothing they can do to stop the downturn. Here goes all the turnaround plays that Jeremy is playing. Stocks like Nike and Estee Lauder are not going back up anytime soon.
But what matters, David, just to step back for a second, is that what's happening is that the erosion of Nike matches the erosion of Intel. These are companies that right now they've lost their way. What?
That's rough, man. That is rough.
Well,
I mean, isn't this enough to satisfy you? It's not good.
Snickers satisfies me.
Amid rising unemployment and social unrest, it is common for governments to come after the finance sector once their risks magnifying harm is widely evident. The Chinese government is leading the global charge in an intensifying crackdown. Chinese authorities have been trying to clean up their 66 trillion financial sector since 2021, when President Xi set his sights on corruption in the industry. If his PBOC gets this wrong, which they will, you're going to see the banks go insolvent. It's going to be an entire financial crisis that could collapse China's financial system further. And if you don't think that it's going to spread all over the world, it will. I think we are in dangerous water now. Just like the path that China's headed down, we're on the same path. just behind them, and rate cuts is not going to be good for the labor market. It's going to make things worse. I think the Chinese bus cycle is contagious. Similar sentiment will likely spread to the US as we experience another great financial crisis.